Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at what comes next for Wall Street banks in 2025.
Plus, we'll discuss the potential global impact of future U.S. tariffs.
But first, we begin in the automotive industry.
This week, we heard that Tesla's annual vehicle sales dropped for the first time in over a decade.
For more, Alix and I were joined by Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst. We first asked Steve about what Tesla's numbers mean for the automaker.
If you look at the fourth quarter, it's actually up slightly by 2%, but they've done a lot throughout the quarter to drive that number, mainly on incentives. So we're likely to see that to continue. But if you look out into 2025, we expect the company to actually give rosier guidance. They do have new vehicles coming out, the refresh of the Model Y, the popular Model Y, and then there's a new affordable vehicle being launched in the first half. That should drive sales in 2025.
So how important are incentives these days, Steve, for the average EV buyer?
It is very important. It's not just on EV. We're seeing that throughout the auto industry, including gasoline cars. Affordability continues to be an issue. If you look at delinquency rates on loans, they're rising. So the automakers have to come in and actually support demand. So we'll probably see that in 2025. But there's reports out there that we, including ourselves, we think that battery costs will continue to come down, and then we'll see probably a better an upturn, likely in 2026, not so much in this year.
When you mentioned that there'll be some product refreshes this year as well as an affordable Tesla, I've been hearing that for a while. What do we mean by affordable? And do we trust this timeline?
Yeah, so I think there's been a lot of questions out there in terms of how if Elon Musk will actually meet his own projection. I think that he will launch the affordable EV, and that's likely to be under 30,000, including that includes the 7,500 credit incentive by the federal government.
Oh, it includes it. So if that goes away, it no longer becomes affordable.
It still is. It's still one of the cheapest EVs out there. I think the new EVs that they're launching going forward will actually be much lower cost than the current Model 3 and Model Y. So there's still some room for them to cut prices and also help maintain the automotive gross margin around the 18 to 20%.
Steve, 2024 feels like a year where the evolution towards electric vehicles hit kind of a speed bump out there. A, is that in fact the case? And B, how do you think about the industry's continued evolution to EVs over the 2025?
Yeah, I think 2025 EV sales will probably be growing at a single digit, and incentives still going to be a bigger part of the story. But I think long term, beyond 2025, that means 2026 and beyond, I think EV sales will recover. Battery costs will continue to come down. More automakers, not just Tesla, GM and Stellantis are launching newer and cheaper EVs. That's going to resonate with the mass market. A lot of the early adopters have bought EVs, and I think the next leg up is really to get the general population to buy EVs and make it more affordable for them.
I guess I just wonder, without the tax credit, if that goes away. I appreciate that Tesla's still the cheapest one out there, but that's not going to be, like, there's no way Paul's buying a $38,000 Tesla, right? Like, that's not happening. So what has to happen for that price to get even lower? And I know that it's a chicken and an egg thing, right? Because you need the demand in order to trigger the production, which then releases lower prices. But that's just not materializing, particularly without that tax credit.
Right. I think we talked about battery costs as being one of them. The other thing is really the charging infrastructure. I don't think the charging infrastructure has been expanded to a point where it's convenient for a lot of for owners or potential owners of EVs. But there's a lot of money being poured into it. There's one company called EVgo. They just got a huge loan from the federal government to expand. We got a lot of automakers, major ones, GM, Ford, and Hyundai, and the likes are actually joining forces together, pooling capital together to expand the infrastructure. So that's why, I think, beyond 2026, beyond 2025, we're going to see improved uptick on EV demand because of not only cheaper EVs, but an expanded charging infrastructure.
Our thanks to Steve Mann, Bloomberg Intelligence, Global Autos and Industrials Research Analyst.
We move next to luxury. This week, guest host Matt Miller, Sonali, Basak, and I were joined by Deborah Aitken, Bloomberg Intelligence luxury goods analyst.
She discussed her outlook for luxury goods in 2025 and why 2024 was so disappointing for some luxury companies.
I began by asking Deborah what happened to luxury in 2024.
I think if we step back to the beginning of the year, January, February, we had some of those, the biggest company CEOs focusing on a normalized year of growth. Now that followed 3 real years of recovery, 21, 22, and 23. So normalized growth was set, we thought, at around 4 to 6%. It started out okay in the first half, and we were looking for the second half to pick up somewhat on the back of that, and that's where the disappointment has been. So second half 2024, a real disappointment because of so much going on economically, politically, but with a big drag in China and travel retail not yet recovering, and also just the fact that we kind of got to peak price, 25% price increases over a 3-year period on average across the sector to pass on some of those inflationary costs. It all just became too much, especially at entry level.
So what's been the problem? Is it just the Chinese economy and the Chinese consumer is so important to this segment? Because as we look at, rich people, Deb, at least the top 500 in the world continue to get richer and richer and richer. So I can't imagine there's any kind of upper limit on Birkin bags.
Yeah. If we look at the companies that have outperformed Hermes and the types of product that they offer to the market, the waiting list there is still in place. Other high-end names like Brunello Cucinelli, these companies are focused 8 to 10% growth year in, year out, and they're achieving that. But really, it's been twofold. If we think about the China market, just to put it back into context, Chinese consumers, when they traveled 2019, as well as spent at home on the mainland, Macau, Hong Kong, and others, were around a third of the luxury market. And we think they're nearer 23% or so. We've basically lost 10% of the market from there. What has happened, though, is that the US has been particularly robust and has picked up some of that. Europe has picked up a little bit, and also rest of the world and other parts of Asia. So when we look at an LVMH's absolute revenue, 2019 versus 2024, even taking out the Tiffany acquisition in 21, its sales are still over 50% higher than they were 2019 in absolute euro terms. But there's been a big shift, and we think that will continue 2025.
Another question I have is how much of this is the macro? Of course, China is a massive story. Perhaps we'll talk about it a little more as well. But another thing I'm fascinated by is the rebranding of some of these large luxury items and brands. Jaguar is one Matt and I had covered a little earlier this year. That's a pretty extreme example, but there are others as well. How much of this is just customer taste changing and the companies needing to react to those changing preferences?
There are more and more reports coming out because we also need to think about the recycle industry too. If we step back into the China situation, one of the big categories would be watches, and watches are higher indexed in China. So that's been a drag for many companies because most of them will have watches, even though jewelry has really stood up well. So that's one side of the equation. If we think about other sides, though, there have been, particularly at the low end with the aspirational side, failures and different creative directors moving around. So there's been some question on where the identity of some of these brands are. But it therefore tends to be the heritage brands, which don't necessarily depend on a single creative director and more really focus on a team and a real high level of workmanship that continue to do better. And what I think we'll see more of that play out also in 2025, if that kind of answers your question there.
Hey, Deb, of all the luxury companies that you cover from a research perspective for Bloomberg Intelligence, what are the ones that seem well positioned to you these days as we go into 2025?
And if we're looking across MODL, it's moved around a lot in the last 18 months, but and generally a little bit of a delay. But companies are being really more forthright in explaining what is happening, where their investment is to back that future growth. So you have the likes of, at the top end, which we've mentioned, Hermes, Brunello Cucinelli. If you look at the numbers out there for top line growth and earning growth 2025 must fully repair and come in ahead of sales. So you're looking at double-digit sales there. We have a range 9 to 12% across Hermes leading, Brunello Cucinelli in the lead. Prada, though, doing very, very well, but a lot on the Miu Miu brand. Richemont doing very well on Cartier, Van Cleef and Arpels. So it's that high fine jewelry and that high net worth individual continuing to buy. And they are some of the names out there, as well as LVMH should further repair because we think that they will do better in the second half of the year. They do have big exposure with DFS into travel retail. And also a lot of these companies, so mid-single digit growth for LVMH, for Richemont, high single to double digit growth for some of those more niche individual brands with big lists, waiting lists out there still for some of the much higher end product.
Our thanks to Deb Aitken, a Bloomberg Intelligence luxury goods analyst. And coming up, we're going to break down why the number of primary dealers in the U.S. Treasury market has decreased.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to U.S. banks.
This week, co-host Matt Miller, Sonali, Basak, and I are joined by Sridhar Natarajan, Bloomberg Senior Finance Reporter.
He discussed his outlook for Wall Street regulation, bonuses, and how banks are preparing for a Donald Trump presidency.
I began by asking Sri what he thinks about the prospects for next year on Wall Street.
If you had to see the best indicator for what people are expecting next year for the banks, just look at what their stocks have done this year. And that will tell you all you need to know about expectations and the outlook going into next year. Goldman Sachs, JP Morgan, Morgan Stanley, they're all up 40, 45, 50%. Jefferies, pure play investment bank, up something like 95%. That stock is almost double.
I was going to say none better than Goldman, but Jefferies is better than Goldman right now.
Sure, not in the same league perhaps, but as a pure play investment bank.
And the percentage rise in their stock.
The percentage rise in their stock, the fact that the stock's nearly doubled this year, all in the back of expectation that there will be a gusher of activity opened up next year. That is where banking expectations are right now. But there are crosswinds, and you're never certain how it will pan out. In fact, if you were to look what happened the day after the November election, all the bank stocks rallied up, and in the days after that went up even higher. But since then, they have given up half their gains. So what the concern there isn't entirely clear. Are they not as certain of that outlook as they were on, say, November 5th or 6th? We're not sure about that. But net, I think if you talk to the C-suite at all of these banks, the hope and optimism that they exude is very clear and visible.
So what kind of deregulation do investors want to see specifically? Because we throw this term around a lot. And for example, we were just talking about deregulation as I think about it, we did see deregulation, but we also have seen, for example, JetBlue was not allowed to buy Spirit, right? So you still have intervention from the government that changes the way these businesses work. In banking, what does Jamie Dimon want to see in terms of deregulation?
I guess deregulation is the word we'd use if we had to sort of align where the Overton window is right now. But realistically, what the banks really want is not more regulation. And that is what they were looking at had it been a Democratic administration. If you look at the action of the Fed, especially the capital rules, the fact that they were facing big increases in their capital requirements was a big headache for banks for much of this year. Even before the election, the Fed did yield. The banks made an aggressive push. They rolled back some of the proposals. They've not taken effect yet. But with the change in administration and the change in tune, banks sense an opportunity to go for the kill and make a bigger ask to make sure that there isn't any increase in capital, or wherever they land up is much, much better than what it looked like at the start of 2024.
And guys, it's not even just the capital rules. It's the areas that were being cracked down on that might not be in the future. For example, Vivek Ramaswamy, who is co-leading that Doge effort, is looking at the CFPB. The CFPB was really a relic of the 2008 reforms. What does it mean for some of that to be rolled back on?
And that actually is one of the most fascinating aspects right now. If you've been addicted to Twitter, X through the holiday season, shame on you. But if you have been, you would have noticed a lot of discussion on CFPB. Yes, the chief Doge officer is there, Vivek Ramaswamy, Elon Musk, even Project 2025. These are names that have come out and said the CFPB needs to be eliminated altogether. Elon Musk and Project 2025's recommendations were very clear. Vivek's tweets over the last week or so make it clear that he's not happy with what's happening. And the incoming chair of the Senate Banking Committee, Tim Scott of South Carolina, has also been quite frustrated with what the CFPB has been doing in terms of their rulemaking, where his point is, you're in a lame duck period. The Fed, the OCC, the FDIC are not doing anything. Yet with the CFPB, we've seen the action on overdraft fees. We've seen the lawsuit against Walmart and one of their fintechs, and some of the other motions that they've put in place, including the crackdown going after the banks because of the Zelle fraud. Clearly, they've been very active. The banking industry is not very happy about it. Some old school GOP members are not very happy about it. But I also find a very interesting strand here is there really are two different kinds of GOP right now. There is one where the faction of populism has been gaining ground and hold, and you can argue that it's coming straight down from the president. For that group, an agency like the CFPB going after overdraft fees, going after things like Zelle fraud, that you would think would normally be encouraged. But your typical pro-banking, anti-regulation GOP faction would obviously see something like the CFPB as anathema. So it'll be interesting to see as we get into 2025 and beyond, which faction in that administration wins.
All right, I had dinner with a high school buddy of mine who is one of the top lawyers in the city. Gets paid a king ransom every year, hates his job. All he did was complain about his job. I'm like, then leave, dude. I mean, he said the biggest change is going to be Lina Khan at the Federal Trade Commission. Getting anybody in there in the FTC other than Lina Khan is going to be a boom to M&A bankers and M&A lawyers.
Yeah, but this goes back to my previous point again. Yes, Lina Khan has been a bane for the banking industry, and you would think with the Democrats voted out. There was even a conversation that even if Kamala Harris were to win, Lina Khan might not stay in that position because of the pressure being put on that seat and the fear in the tech industry and beyond of how much it was crimping deal making. But at the same time, listen to some of the comments made by Vice President-elect J.D. Vance during the campaigning cycle. He did not sound like someone who is the absolute anti-Lina Khan type. So again, it remains to be seen which faction of the GOP has the louder voice. Okay. But if you didn't have a Lina Khan-like figure...
There's only one voice in the GOP, dude. It's over. It's over. And having been, voting for Reagan in 1980, I can tell you, there's only one voice left.
But even that one voice has not been the most predictable voice, so let's admit that.
I'm never bored of regulation, but I'm bored relative to the other topic that I want to talk about. Money, right, yeah, exactly. Bonus season. Listen, deals did not yet come back, so is there an expectation that bankers are going to get paid anyways?
Deals did not come back to the extent you would have wanted to see, but they have been up relative to last year. They're still well below their long-term averages, and the expectation is that you will get there. So some of the bonus payouts this year will not only be a recognition for the work done this year, but what you need to pay to keep top talent in their seat. And this is visible not just in bonus payouts. Look at the managing director promotions. Look at the Goldman partner class. Some of these top promotions, they have been bigger sizes than in the past. They are battlefield promotions, recognizing the work that's already been done, but also telling them that there's a lot more opportunity to make a killing in the year ahead.
Our thanks to Sridhar Natarajan, Bloomberg Senior Finance Reporter.
We move next to a Bloomberg Big Take story we focused on this week entitled Treasury's $50 trillion Deluge will test strained dealer pipes.
The story looks at how the number of primary dealers in the U.S. Treasury market has now decreased, and it discusses how those remaining are facing mounting pressures due to post-financial crisis regulations and a growing U.S. debt load.
For more, guest host Matt Miller, Sonali, Basak, and I were joined by Alix Harris, Bloomberg Bond Reporter. We first asked Alix why being a primary dealer isn't easy these days.
You look at Citadel in this case, and they had been vying to become a primary dealer for years, and finally in September said, you know what, thanks but no thanks. This is just a losing proposition. And I think that's how people are feeling about it now, and why you're not seeing the primary dealer community even grow to keep up with the amount of supply and the amount of debt that the government is issuing. And that's a problem, because you need those primary dealers. You need them to facilitate these, in these markets, from the auctions to secondary market. And remember, their balance sheets for these dealers isn't just treasuries. It's a lot of other things. It's equities, it's mortgage-backed securities, it's asset-backed securities. So you're playing with all these things. And as you can see what happened, if you look back to March 2020, I mean, that's a really good example of what happened when the Treasury market ceased to function and dealer balance sheets just could not handle what it needed to do across all asset classes. And that's the scary thing, that it's a regular occurrence.
Maybe let's take a large step back for a moment here, because there are a lot of confusing dynamics that are happening in the Treasury market. One is the size of the U.S. debt load alone. Then there comes the plumbing questions. Why overnight funding seems to hit pockets of stress every so often. The dealer balance sheets being constrained as they are, as you say, and then hedge funds trading with a lot of leverage in this system. What is actually the problem here and the risk in the way the plumbing is working?
So right now what's happening, and where the primary dealers are having problems, is when you're asked to facilitate and intermediate in this market, but you don't have the balance sheet to do it, you have to charge higher funding costs. So that means if you are looking to borrow treasuries, say in the repo market, and you're a hedge fund or an asset manager and you need to borrow to finance securities, you are going to have to pay more. And there might be a point where they are not equipped to pay as much as the dealers are asking them. And so that's when you get backstops and you get, stopping out of positions. And all of that has to make its way back onto the dealer balance sheets. And so that's where they get clogged. And right now, there's $400 billion in aggregate treasuries alone sitting on dealer balance sheets. And then every time you get a treasury settlement cycle, so the middle of the month and the end of the month, you're getting a backup in repo rates. It's becoming a regular occurrence, and we're seeing it quite often this year. July, dealer balance sheets were stuck. End of September was a very volatile quarter end that nobody expected. Year end has thankfully been today it's very mild. Repo is under control, but it's because the minute the calendar turned to October, everybody said, wait a minute, we have to be better prepared for this. And so you saw repo rates actually back up to 5.5% in the middle of November, because people said, I don't want to get caught. I got to do this now.
Alix, another question about this too. We're talking about the Treasury market here. It's not only the deepest, most liquid market in the world, it's one of the largest, and it also underpins the cost of every other type of borrowing. And if you're talking about the need to kind of back up rates, as you're talking about in certain parts of the market, at what point does this become a larger issue, even a taxpayer issue?
Oh, well, you can see in some cases it already is. The auctions are just going to get more expensive, because it's just going to get harder and harder for these dealers to continue taking down this supply. And what's interesting is, remember, the dealer balance sheets are not created equal. So, dealers have the autonomy to decide, where their priorities are. And, during the Treasury refunding one year, I think it was last May, they were doing something called Blue Sky, and they were just kind of kicking around ideas, what they could do to help improve Treasury market functioning. And one of the things they proposed is almost doing a table to see who the biggest dealers were in the Treasury auctions as a way to sort of light a fire under the rest of the dealer community to say, hey, like if you're not doing your part and you're not pulling your weight, you have to, because there's just too much supply to leave it to a handful of dealers to be taking down. There's only 24 of them. We're down from the peak that we saw in terms of the number of dealers that we saw in 1988. So this is so critical that everybody is playing their part in here. And if they're not, there are serious consequences in the terms of costs to the economy, to the taxpayer, and to those just trying to finance their transactions in the financial system.
Our thanks to Alix Harris, Bloomberg Bond Reporter. All right, coming up on the program, we discuss some of the successes and failures in the chip industry last year.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move next to the chip sector.
Of the 10 public companies in the world that investors value at more than $1 trillion, a third are in the chip industry.
In 2024, Broadcom joined TSMC and NVIDIA in that exclusive club, but the chip industry also saw some failures during the past year as companies like Intel struggled.
For more on these companies, guest hosts Matt Miller, Sonali, Basak, and I were joined by Kunjan Sobhani, Bloomberg Intelligence Senior Telecom Analyst. I first asked Kunjan to break down the differences between Broadcom and Intel.
You really have to look at it as two companies, right? One is your legacy chip company like NVIDIA and Broadcom who designs their chips and sells them. And the other is sort of a semiconductor manufacturing company similar to something like a TSMC or a Global Foundry. On the product side, this is where they have sort of missed out on that AI train. It was really, them not coming to the market with the AI products in time, and they are still sort of struggling. We don't have a good pipeline for their AI revenue ramp, especially in the GPU or the accelerator space. And on the server side, they're having challenges with their competitor AMD taking share almost every quarter over the last year or so. The contract manufacturing that you're talking about, that comes from the manufacturing side. Since the ex-CEO now, Pat, took over the helm, the North Star for the company for its turnaround was become the sort of leading edge node manufacturer of the West. If I may compare, it becomes sort of the TSMC of the West. And that's where they are really, have been investing a lot, really focusing to get advantage and manufacturing leadership back here in the US. And that's where all the grants, your CHIPS Act subsidies, your tax credit, et cetera, are designed around that business.
By the way, speaking of tax credits, is Intel just done? Do they bring in somebody to break it up and sell off the pieces? Or because they are still looking at like $20 billion from Uncle Sam, right?
Yeah, look, they haven't said anything specifically, but from our analysis of the company, including valuation and how the stock is trading right now, we think there's likely going to be definitely some kind of divestiture, some kind of investors brought in. We think the more likely portions of the business are going to be the PSG or the Altera business that they had acquired. There's also a lot of equity stake they have in Mobileye, which they have a way to diversify and raise some cash. These two would be, I would say, the most highest probability exits. The discussions around breaking up the foundry business other than the product business, that's something really hard to do, especially how important strategically Intel's manufacturing plants are for the US.
Well, speaking of how important the manufacturing plants are for the U.S., there's a new presidential administration. How do we expect President Trump to approach the industry, and would they get any support above and beyond what we've seen under the Biden administration and the CHIPS Act?
Yeah, that's a great question, and there's multiple sort of angles to look at it. just looking at from a manufacturing and subsidy perspective, we don't expect anything to change here. The government has been very supportive of bringing back manufacturing here, especially leading edge node and advanced manufacturing when it comes to semiconductors. So we don't think this will be this tailwind will continue to be a tailwind even in the new administration. However, there are different angles now. One is the M&A landscape. Will the new administration be more easier on M&A, which really has not happened in semiconductors because of, again, government regulation being primary gating factor. Again, this area, when you look at the data versus the sentiment, the data doesn't show that the Trump administration would be significantly a booster for M&A. If you looked at the deals that were sort of blocked or went into a lot of sort of regulatory concerns during his prior term, the data shows that it was similar to what we saw in Biden administration. So from that angle, we don't expect, at least from the data, significant things to change. There are different angles here, especially pertaining to China. We do expect, the scrutiny against China to increase, and that could result into multiple different aspects. One is sanctions on Chinese-based companies, and most of the U.S. semiconductor your giants have significantly high exposure to China, anywhere from 40 to 60% of their revenue. So that could come at risk. The second could be retaliatory measures by China on U.S. companies who have significantly high revenues in China. One example recently was China initiating a probe on NVIDIA. So we expect something in terms of the tariffs or the sanctions to play a larger role on the U.S. semiconductor companies.
Kunjan, I'm looking at the real winners in your space, the chip space, obviously NVIDIA, Broadcom, those are the clear winners. What do tech investors feel like 2025 holds for some of those names that have really been propelled by AI? Is there more to go? Is this a market? Is this an earnings growth story that can support more performance out of these names?
Yeah, fundamentally, we expect 2025 to be another really strong year for AI chip names, with the one key caveat that we expect this year not just one name to take all the glory and take all the winnings. We expect a much more broad-based growth going into ASIC names, AI networking names, the one, like you said, Broadcom, but there's even others that we expect to continue and take small share of the bigger and growing AI wallet, because the hyperscale spending is expected to grow again 20% this year. So we think there will be more names than just a handful of them this year.
What's the risk to that 20% growth story for hyperscaler spending? Because at the end of the day, we've seen tremendous ambition from big tech companies to be working with NVIDIA, of course, and others. But do you think that could face a wall if investors also get fatigued?
Yeah, I mean, you are seeing that concerns come in. So when you look at from a growth rate perspective, the growth rate is normalizing, right? When you look at last year, it was somewhere between the mid 40s and now sort of half 20s. But, we so far have not seen any data showing that at least in 2025, you could see a shock to this number. The second point is, so far, since the advent of Gen AI, these estimates have proven to be conservative. So when we end the year, we have typically, for the most companies, seen the numbers of the CapEx numbers come higher than what we had expected at the beginning of the year.
Our thanks to Kunjan Sobhani, Bloomberg Intelligence Senior Semi-Analyst.
We move next to trade. Policymakers around the world are watching the U.S. for potential trade tariffs when President-elect Donald Trump returns to the White House in January.
A trade war triggered by U.S. tariffs could be extremely negative for the global economy. And this week, we heard that China may sell products to Europe at discounted rates if the U.S. imposes new tariffs. And that's according to ECB Governing Council member Klaus Knott.
For more, guest hosts Matt Miller, Sonali, Basak, and I were joined by Brendan Murray, Bloomberg Global Trade Editor. We first asked Brendan if he knew anything concrete in terms of Trump's tariff plans.
Nothing concrete. In fact, the word that I keep hearing is uncertainty around tariffs. If tariffs are Trump's favorite word, then business's least favorite word is uncertainty, and that's what they're getting. What we heard from the ECB official was fear about disinflation from China. We often hear about tariffs causing inflation from the U.S. if Trump were to put tariffs on Chinese imports. The flip side of that is deflation, and China, has a couple of tools at its disposal. If it wants to use in a trade war, it could subsidize its exporters. and reduce the cost of their production and make the cost of their exports go down. It could also let its currency weaken. Now, economists are kind of mixed on whether the degree to which they think that those things will happen. But this ECB official, we heard, is clearly putting his finger on something that the Europeans are worried about. They have a much slower growth outlook than the U.S., and so there's some talk that he has right to be concerned.
It's interesting, Paul. You're looking at an interesting function on the terminal, I know, that can show you pretty granularly how the U.S. trade partners are panning out.
ECTR
I'm
Go.
having fun with it right now. That's why you guys can have your conversation. I'm just clicking on seeing who all the trade partners we have and everybody else has.
But one thing interesting about this is if you kind of change the main bar to China, you can see also just how much China is ingrained into the global economy. And so it's not just China that would be concerned about that kind of slowdown, or the ECB, is it, Brendan? Aren't there many other countries that would share that same concern?
Oh, absolutely. China is not just the largest trading partner to countries like Germany and others in Europe, but it's the number one trading partner to a lot of countries, and a full-blown trade war would not just take place between the U.S., China, Europe, and China. It would hit lots of different countries.
You know what? During Trump 1.0, we heard China, so much about China, big tariffs on China. Trump didn't want TikTok because obviously the Chinese can spy on us with that. Now he's happy to have them spy on us through TikTok. In fact, he's going to push at the Supreme Court level to try and get the TikTok ban extended or lifted. And the first buddy, Elon Musk, does so much business in China that speculation I hear is that he could be much softer on them as a trading partner in this Trump 2.0 administration. What's your take on that?
Yeah, it's something we've reported on quite a bit over the last couple of weeks, and points to how transactional Trump is as an executive and as he was during his first presidency, and he will take things case by case based on what the people who we talk to, and something like TikTok or sort of other things that come along. He's going to take case by case, and he's going to hear out the arguments on both sides, presumably, and make his decision based on what he thinks is best for him politically and for the economy. So, yeah, we'll see. It's not a black or white issue. It's there's some gray area in there, and things like TikTok, are a good example of that.
Brendan, do we have any idea how much of this tariff stuff is just negotiating ploy versus real economic policy? Has anybody kind of weighed in who may have the president-elect's ear on this stuff? Scott Bessent?
Yeah, I don't. Is the poker player sitting across from you bluffing, or is he not bluffing? It's anybody's guess, really. I think that the answer really is that he will, take things based on what he thinks are threats to national security. Even if he is just putting a negotiating tool out there, it's still having an effect. Companies are still stockpiling. So whether it's a bluff or a negotiating tool or not, it's still having an economic effect. We were looking at the state of volumes through the ports of Los Angeles and Long Beach. They're going through the roof right now. Yep. It's normally a quiet time of year. So this may be a tactic, but it's actually affecting the inventory building of companies.
But Brendan, I mean, what's the thinking on TikTok? Not to focus too much on that, but isn't it generally accepted that it is a threat to national security, and the Trump administration now is okay with that?
Look, I think this is getting to the heart of the different kind of presidency we're going to see coming up starting on January 20th with advisors like Elon Musk. Elon Musk has every motivation to make sure that the U.S. and China still do business together. He's got a $2 billion mega factory there. He wants to sell cars to Chinese consumers. So I think this is what you're going to see is kind of a softening of some of these positions, like the one TikTok that you raised.
Our thanks to Brendan Murray, Bloomberg Global Trade Editor.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.